The Bank of Canada today increased its target for the overnight rate to 3.25%, with the bank rate at 4% and the deposit rate at 3.25%. The bank is also continuing its policy of quantitative tightening. Inflation around the world remains high and broadly based. This reflects the strength of the global recovery from the pandemic, a series of global supply disruptions, and elevated commodity prices, particularly for energy, which have been pushed up by Russia's attack of Ukraine. The strength of the US dollar is adding to inflationary pressures in many countries. Tighter monetary policies aimed at controlling inflation are weighing on economic activity around the world. As the economy is slow and supply disruptions ease, global inflation is expected to come down. In the United States, labor markets remain very tight even as restrictive financial conditions are slowing economy activity. The bank projects no growth in the US economy through most of next year. In the euro area, the economy is forecast to contract in the quarters ahead, largely due to acute energy shortages. China's economy appears to have picked up after the recent round of pandemic lockdowns, although ongoing challenges related to its property market will continue to weigh on growth. Overall, the bank projects that global growth will slow from 3% in 2022 to about 1.25% in 2023, and then pick back up to roughly 2.25% in 2024. This is a slower pace of growth than was projected in the bank's July Monetary Policy Report (MPR). In Canada, the economy continues to operate in excess demand and the labor market remains tight. The demand for goods and services is still running ahead of the economy's ability to supply them, putting upward pressure on domestic inflation. Businesses continue to report widespread labor shortages, and with the full reopening of the economy, strong demand has led to a sharp rise in the price of services. The effects of recent policy rates increased by the bank are becoming evident in interest-sensitive area of the economy. Housing activity has retreated sharply, and spending by household and business is softening. Also, the slowdown in international demand is beginning to weigh on exports. Economic growth is expected to stall through the end of this year and the first half of next year as the effects of higher interest rates spread through the economy. The bank projects GDP growth will slow from 3.25% this year to just under 1% next year and 2% in 2024. In the last 3 months, CPI inflation has declined from 8.1% to 6.9%. Primarily due to a fall in gasoline prices. However, price pressure remains broadly based, with 2/3 of CPI components increasing more than 5% over the past year. The bank's preferred measures of core inflation are not yet showing meaningful evidence that the underlying price pressure are easing. Near-term inflation expectations remain high, increasing the risk that elevated inflation become entrenched. The bank expects CPI inflation to ease as higher interest rates help rebalance demand and supply. Price pressures from global supply disruptions fade, and the past effects of higher commodity prices dissipate. CPI inflation is projected to move down to about 3% by the end of 2023 and then return to the 2% target by the end of 2024. Given elevated inflation and inflation expectations as well as ongoing demand pressures in the economy, the Governing Council expects that the policy interest rate will need to rise further. Future rate increases will be influenced by our assessments of how tighter monetary policy is working to slow demand, how supply challenges are resolving, and how inflation and inflation expectations are responding. Quantitative tightening is complementing increase in the policy rate. We are resolute in our commitment to restore price stability for Canadians and will continue to take action as required to achieve the 2% inflation target.